What is up, you guys? Pete DiCarlo here, and today we're going to go over my long-term small portfolio. So before we start, this is what's called our $0 to $50,000 growth challenge. So in my private academy, link is down below. Get 90% off your first month. We are doing what is called a $0 to $50,000 portfolio challenge. It's very easy to grow money when you have money, but it's very hard to actually grow money and to start a long-term portfolio and eventually live off of that money if you don't have a lot of money. So the point of this was I was going to start with $400 in my account, and I would put $100 every single week because I feel like that's very reasonable for a lot of people to do in the portfolio for 5 years, and the goal would be to have $50,000. Now, in order to do that, we would need to make an average of 22% returns in a year. And you'll kind of see that's why I have this portfolio built the way that it's built. It's very aggressive, like very, very, very aggressive. But once a month, I come out here on YouTube and I show what is in the portfolio. What am I doing? What are some things I've bought, some things I've sold? But I also do it on the Academy once a week, or whenever I make a live play, I put it there. But I come out on YouTube and I show you what I'm doing, why I'm doing it, and we're going to kind of look at this portfolio. And if you are doing the 0 to 50K challenge with us, awesome. If you're not, maybe these companies could end up being something you could add to your own portfolio. So like I've already said, this is not how I'd build a balanced long-term portfolio. When you're building a portfolio, there's a lot of different things to think about, but the number one thing to think about is your age. We talk about it a lot. If you're older, if you're like 5, 6, 7 years away from retirement, you don't want to have an aggressive portfolio, because if we see something that happened back in March happen again, you could really screw yourself. So you don't want to see that. Now, if you're somebody young, you could have a very aggressive approach, because even if everything blew up in your face, you're going to be fine, right? You have a lot of time on your side. And so when we see this portfolio, you'll notice number one, it's tech heavy, because I need to get some pretty aggressive returns. The other thing you'll see is that most of the companies have pretty small market caps. And the third thing is, these are the only companies I think that are really fair right now as far as valuation standpoint, or at least, really, really on sale. And we'll kind of see, what I bought these at. I don't know if you can actually see this here, but on a lot of these, I don't know if I can show you how much I'm up. I don't really use this website much. I know on my actual TD Ameritrade account on my phone I can show you, but a couple of ones were up huge, like SPCE, where I think we're up 15%. Small Direct Club, we're up like 70%. Planet 13, we're up like 20%. And so we're going to go over everything now. Now, the companies I had in this originally that I've sold so far was Peloton. Peloton was the first one. And Peloton, I really like. I love Peloton long term. I just felt like at the time, and we'll go on TOS real quick, PTON. I felt like at the time, Peloton was just moving up and moving up and moving up. I sold around like 112, and I felt like I didn't have enough money in it because I only put $100 in. I made like 70% returns, and I felt like, at this point, I might as well sell, because I'm not going to average up into a position. So I'm not going to like continue to average up into a longer term position. That's how I am. I don't know. It's really weird. I know that that's like the smart thing. If we're looking 30 years from now, you just want a dollar cost average your way into these companies. But for me, if I'm trying to make a more active, aggressive approach to this portfolio, I'm not going to average up. And I felt like Peloton was no longer a good deal, so I sold it. I also sold Uber. Uber was one of those companies where I'm very bullish on the company long term. However, I feel like my price targets have definitely come down a lot. If you guys have been with me for a while, one of the first videos I made was a video on how I think Uber could be worth $350 to $500 a share by 2025. I no longer think that. I think probably about $200 a share, maybe $150 a share. And a lot of it has to do with the layout of the whole Rona situation. Not only that, but the fact that, we're not going to go too deep into this, but the bread and butter of the company was ride sharing, and that's kind of just gone now, right? And the killer on the company was deliveries, and that's kind of their bread and butter now. So a lot of things with the company fundamentally have been messed up. It's the same thing with like the whole California W-2 thing with Uber. That's not really too good of a thing for them right there. So I ended up selling Uber. I was up pretty good, and I felt like there were other companies, like at the time Cisco and Gan, could provide me better returns. So that's why I ended up selling those. Now let's go over the actual positions that we're holding right now. You'll see these here. How do I zoom in? Okay, there we go. There we go. All right, there we go. It's a lot easier for you guys to see. So these are the positions that I currently hold. JWN, Apple, Cisco, which I'm probably going to sell Apple. We'll talk about that. Cisco, Small Direct Club, GAN, SPCE or Virgin Galactic, Dropbox, and Planet 13. So let's quickly just kind of go through them real quick. We'll kind of go over why I picked them, maybe look at some financials and whatnot. And the first one is JWN. So if you guys don't know what JWN is, it is Nordstrom Brands. This is like the ticker for Nordstrom. There's also Nordstrom Rack, which is another great company. And this company pre-whole Rona, I was looking at for a while. This was a stock that was trading at $40 not even a year ago. Now we're all the way down at $13. We're actually close to like recent lows. So you can see right here a market cap of $2.2 billion, the EPS of negative $2.92. There's obviously no PE ratio because we don't have profits, and there's obviously no dividend because we don't have profits. We're at the low side of the 52-week range. If we take a quick look at fundamentals and we look at your income statement, we can see that there is small amount of growth, if not stagnation, in revenue over the past 5 years. We can also see here that the total net income is dwindling a bit from 18 to 19 and to go up about $50 million. And then you can see that we dwindled again about another $50 million into 2020. Let's take a look at the balance sheet. Now remember, this is not how like I deep dive a company. These are kind of like main numbers that I feel minimally we should go over and look at together, which is going to be your total assets to liabilities, which right here is like a 1.1, which means we have $9 billion in assets and $8.7 billion in liabilities. And then I also want to see total revenue increase or at least hold, and I want to see net income, same thing, go up steadily or hold. So in this case, the financials don't look the best, but they're not the absolute worst that I've seen. The thing with Nordstrom is it's a great brand. They carry a lot of great brands, but the problem is they really cater towards the higher spenders, right? If you go to Nordstrom, you're not going to go get a pair of dress shoes for like $200 or a leather jacket for like $400 or $500. You're going to go get a leather jacket for like $4,000 or $5,000. You're going to go get a pair of dress shoes for like $2,000. Nordstrom Rack, however, is pretty cool, and I actually shop there a lot. I think that's where I got this shirt. They're cool because all the stuff they can't sell at Nordstrom or the Nordstrom brand that they don't sell at normal Nordstrom because they outsource to other brands, they'll put it at Nordstrom Rack. I like the way that this company is managed. However, if there's one thing that we've seen is retail is getting killed, which has really pushed the stock down. If we look at the past 3 years, it was trading at $70 back in July of 2019. But the big downside is retail has been getting killed for a long time. And on top of that, we have the Rona situation, which kills retail even more. And then on top of that, we have the fact that the people who make the most, so there was a study, and I'll link it down below, but in the first 4 months of the whole Rona situation, a lot of consensus reports went out, questioning people about their spending habits, looking at different statistics on how people have been spending their money since the Rona. I think it was something like people and families who made less than $50,000 a year only diminished their spending habits by 5%. So that means that if you made $1,000 a month or $2,000 a month, you really only decreased your spending by 5%, which is not a lot. However, if you had a family that was making above $50,000, so $60,000, $70,000, $80,000, $100,000, $200,000 a year, they decreased their spending by almost 60%, which is crazy. So essentially, rich people are spending less, poor people are equally spending almost. And a lot of it has to do with education. A lot of it has to do with poor people are getting more money from the government, all that type of stuff. So right now, Nordstrom is hurting. This is not a company I have high conviction in. This is not a company that I would probably personally buy in a long-term portfolio and put massive amounts of money in. But because I am going for a very aggressive return on this portfolio in the next 5 years, if this company can actually bring themselves out of the gutter, this could be huge. And I'll do a full breakdown on this company in a future video. But this is the first company that I have. I also bought this company because I'm trying to diversify a bit from technology. Everything else in this portfolio is really going to be tech besides Planet 13. All right, so the next one is Apple. I've done a full video on Apple before. I will link it down below, or you can just find it on my channel. Market cap, $2 trillion, EPS of $3.29, PE ratio on the high side of 35, 0.71% annual dividend. I purchased this not because, well, one, I love Apple. Two, we had that really big pullback a while ago. I entered into this position and I kind of just started it so I could add to it later on, but it doesn't look like we're going to continue to fall. I was hoping we'd see Apple at $95. Doesn't seem like we're going to get that. So I will probably end up selling Apple in this portfolio because I'm not going to average up into this position. I will say the fundamentals are phenomenal. The numbers are phenomenal. The company is amazing. I love everything about this company. The only problem is it's never on sale. If you have a long-term portfolio, I think that Apple is a big staple that you should have, especially in the tech industry. The next one is Cisco. So Cisco is a semiconductor company. They also do a lot of other things. They have a huge market cap of $168.7 billion, an EPS of $2.64, a PE ratio of 15. They have a nice hefty dividend of $3.62% or $1.44 a share. They're trading at a pretty low area within their 52-week range. Technically, if we look at a little bit of technical analysis, but we're not really trading on this portfolio. But if we look at some technical analysis here, we can actually see that Cisco is sitting above a pretty nice support. We have a nice bullish divergence. We should probably see a push in the next couple months up to $41 and then $44. So technically, this company looks really good. But I love the company fundamentally as well. I started purchasing this after we had that big sell-off after earnings. Earnings weren't really that good, as people had expected, but I still see a lot of upside to this company. And this is a company that I actually used to own a while ago, but I sold over the long term because I didn't feel like it was fairly valued anymore. We can see revenue right here has just kind of been stagnating around $48 billion. Let's see. Okay, here we go. So we can also see that total net income, in 2018 we had a big dip, but 19 and 20 we kind of just sitting sideways. A lot of these companies are cyclical, so you might see these kind of dips, or maybe anytime you see something like this could be a cyclical company. It could be a company that did a major acquisition. It could be a company that maybe did a merger, not them. Maybe it could be something happened on their balance sheet. Now, if you saw 9.6 billion, 110 million, and then like 90 million, and then 80 million, that's bad. But if you see a sharp dip, you just have to do a little further research into what happened that year to cause that to happen. But overall, financials, this company's not like growing at an insane pace, but it's still a pretty strong company that I feel like is actually undervalued, which there are very little companies I feel that are very undervalued at this point. You can see here total assets 94.853 billion, total liabilities 56.933 billion. If you guys have been with me a while, I like companies that have at least a 2-to-1 or a 3-to-1 ratio of total assets to total liabilities. So in this case, we have a 2-to-1 because the liabilities are 50 billion, right? And we have almost 100 billion in assets, which is 2-to-1 ratio. I really like this company. I plan to actually make this probably one of the biggest positions so far that I have. Number one, because it's a great dividend. And number two, because I believe in the company. And number three, the most important thing is it's appropriately valued, right? If we're trying to get these bigger returns of 22 to 30% return a year, we need to find things that are undervalued. So Cisco is a really good company and I really like it. All right, Smile Direct Club. So I did a whole video on Smile Direct Club. I'll also link that down below. I love this company. I was buying them at 6 and 7. I'm up like 70% on my money right now. I will not be adding to this position. I'll probably still hold what I have. If we do get a major pullback, I may add more. This thing is up huge. This thing's up like 60% in the past 5 weeks. So I'm not going to do a full breakdown on this because I did that in a prior video. I'll put it below. But I love this company. I think this company has huge potential over the next 5 years. I really do. I think they're still undervalued at $12.50. I think fair value on this company is like $16. But overall, great company. I'm up really nice on it. I will probably not be adding any more to this unless we get a sizable pullback. But I actually really do love this company. Next one is GAN. GAN is basically think of GAN. They're the back end to all these gambling, companies. So like DKNG, online gambling company, they're the back end. FanDuel, they're the back end. They had a big dump from like $28 all the way down to $15 because they lost the contract for the sports book betting on FanDuel, which is huge. FanDuel is one of the biggest sportsbook betting apps that there is. And GAN used to run the back end for the sportsbook. They still have the casino part, which is very, very important. I still love this company. I've talked about them plenty of times. Small market cap, $540 million, no dividend, of course, 0 EPS. They're still negative, but this company is phenomenal. I see huge returns in the future for GAN. So I feel really great about that company. Also, stay till the end, and I'm going to talk about a company I'm planning to add, especially if we get a sizable pullback and why. And I think it could be a huge whole Rona play during the winter. We'll talk about that in a second. All right, Virgin Galactic, or SPCE. I've talked a lot about this company. I've done videos on this company plenty of times. I love this company. I love the chairman, so Chamath Palihapitiya. He was one of the founders of Facebook. He is my spirit animal. I love him. Sir Richard Branson is another huge investor and chairman in this company. I love Sir Richard Branson. They have a great executive team around them, a great CEO. This is like a Tesla type company, not like an electric car manufacturer, obviously, but a company that has great and lofty ideas. But if they can execute the way that they want to, this company could change the world. It really could. So just very quickly, if you don't know, Virgin Galactic, right now they're working on space travel, so touristy space travel. They do have a lot of contracts with NASA, but the main thing they're known for is space travel. So you could pay $200,000 or $250,000. You could get a trip that's like 26 minutes out into orbit in space. So they're trying to make space travel like a normal civilian thing. The other big thing they're known for is creating these jets. Let me see if I can find Virgin Galactic jet. They're creating these jets where I think they only hold 100 people or something, but they're creating these jets where you could essentially go from, well, not that one. No, these are like the space ones, but they're creating these jets that you could actually go from like New York to London in an hour and a half, 2 hours, or from New York to LA in like an hour and a half, 2 hours. It's insane. This company's fundamentals, they're not the best, right? If you're somebody who wants to retire in the next couple of years, don't go putting your money in Virgin Galactic. But I love Virgin Galactic. This company has huge upside potential. I'm up pretty big on the shares already. I will definitely be adding into that. And kind of to clarify, the reason I'd be adding and averaging up in a company like Small Direct Club or SPCE and not a company like a Peloton, well, maybe not Peloton, but not a company like Apple, is because I think the room for growth in those other two companies is a lot higher than the room for growth in Apple. The next one is Dropbox. Dropbox was one I didn't really expect to buy. Making these videos, I had the most, like literally the worst and terrible time transferring my stuff from this computer to my other computer to edit on Mac and edit on Final Cut and like all these different things. And then I bought Dropbox and I was like, dude, how did I live without this? This is phenomenal. Like, so many companies are using it. I love this company. Like, as a user, I love this company. And Dropbox, from a technical standpoint, took a huge hit. We're down right in this medium range of low to high within this past year. And market cap 8.4 billion, EPS of 8 cents, PE ratio is trading at a ridiculous 248. The fundamentals of this company, let's kind of quickly go over this. Great growth. Even though we have a high PE, great growth of total revenue, great growth of net income. So we are losing money, but I mean, we're losing a lot less money. $53 million lost in 2019 versus $485 million in 2018. So those are good numbers, right? Not a Benjamin Graham type company to invest in. Definitely not. But still, not the worst. Total assets 2.6 billion, total liabilities 1.8 billion, so like a 1.3 1.4 ratio of assets to liabilities. Yes, a risky company, but overall I really like the company. I think they're undervalued and I think they have huge growth for the future. And the final company, Planet 13. If you guys don't know what Planet 13 is, think of like Dave and Buster's on steroids for marijuana and adults. They are so much more than just like a marijuana gaming type amusement park place. But this company has the potential to be huge. Right now, it's a pink sheet OTC, so you cannot buy this on Robinhood. You can only buy this on TD Ameritrade, guys. There's an insane amount of risk, with this. This is one of the only pink sheet companies I've ever invested in that I see a potential huge long-term future. Market cap $527 million, PE ratio of 0, EPS negative 9 cents. This is not a company that I am investing in because I like the fundamentals. This is a YOLO and a half. They have 2 gigantic locations. One is in Nevada, the other is in California. So in Nevada, they actually have the retail center. So the big thing, there's like two moving parts to this company. The first is the retail center. This is the Planet 13 Superstore. There's a whole bunch of games and kind of think of it like a theme park. They have their own actual, like where they sell marijuana, different candies, different edibles, like so many cool different things. Like I said, think about Dave & Buster's with marijuana, but upscale. They also have in-house brands and wholesale. So they have their own cultivation factories. They have their own production facilities. They make their own stuff. So like they have, it says, multiple top SKUs. If you've never worked in real estate, in retail, a SKU is basically like a product, right? Like every product has a SKU number. So this candle would have a SKU number. So they, in the future and now, will be making their own candies, their own chocolates, their own creams, their own everything you can think of. 29% of in-house sales are Q2 in Planet 13 brands. So that's really good, right? Think to yourself, why is that so amazing? Well, because number one, your profit margins on in-house brands are gigantic. And also, if you create an in-house brand, you can sell it at other places too. So that's really good. This is the investor relations page. I definitely, say take a look if you really want to invest in this company. It is very, very, very risky, but I see huge upside potential for this company. So that's kind of the breakdown of this portfolio. This thing is going to change as we move into the end of the year and into next year, because while I want this to be a longer term portfolio, if something doesn't make sense, if a company no longer, in my opinion, looks attractive, I am not going to hold on to it. That's just how I am. I don't care if it doesn't make sense. I don't care if I get taxed more heavily. If a company doesn't make sense, I'm not going to hold on to it. So let me know what you guys think, right? Let me know what you think I should add. I'd love to hear from you guys, because as investors, we can kind of get blinders sometimes and we can just only see what we normally trade and what we normally invest. So let me know what you guys think of the portfolio. Let me know if you guys want me to add something, take something away. I always want to hear from you guys. Make sure you hit the subscribe button and hit the like button. It really helps this channel grow, guys. And until next time, I'll see you guys. Peace.